Kumar Subbiah, who is the CFO at CEAT, joins us now to talk about that. Mr. Subbiah, good morning and thanks a lot for being with us on CNBC TV 18. First, on the demand situation, there's a big resurgence that we're seeing across the board, and you supply to almost all categories. So just tell us, between passenger vehicles, two-wheelers and commercial vehicles, where is the maximum amount of traction now, and what do you see as a year-end growth for the industry and for CEAT?
Okay, good morning, Sonia.
Morning.
Overall, at the business units level, we are seeing traction in replacement and more in OEMs. And as far as export is concerned, we are seeing some headwinds, particularly from Europe. So OEMs and replacement growth has been steady for the last 5 to 6 months or so. And with respect to categories, passenger vehicles, two-wheeler tires, we have seen growth. In case of truck and bus, radial side, more with OEMs we have seen growth, but otherwise in the replacement market, it has been steady since February. That's the way the market stacks up.
Okay, so if you can give us some numbers, right? I mean, in Q1, your overall volume growth was up 7.5% quarter on quarter. Can you do this kind of growth for the remaining quarters, about, high single digit to perhaps double digit? And for the full year, brokerages like Nomura have forecasted about 12.5 to 13% volume growth. Is that a reasonable assumption?
See, quarter one normally is the average revenue is more than the other quarters. So therefore, quarter four and quarter one, we normally tend to sell more. And therefore, on quarter, it is difficult to deliver that kind of a growth in quarter two and quarter three. Normally during monsoon, the tire demand tapers down, so therefore difficult to sustain. But overall, year-on-year basis, okay, we would have strong growth in the current year versus last year. I think I expect it to be in the double digits. High double digits. That would include both value growth as well as volume growth. That's the way we expect the current year's growth to be.
Volumes in double digits, well, that's more or less in line with what the brokerages are estimating. A couple of questions, Mr. Subbiah. What's your current mix? I think earlier higher amount of your sales was in replacement market. If you could give us a breakup of replacement, OEM, as well as exports. That's the first part. And also margins. That's been the worrying factor. It's come down to single digits or mid-single digits. The last time you delivered double digits was 4 quarters ago. When do you get back to double digits on both these two aspects? Go ahead.
Okay, as far as the overall broad mix is concerned, OEMs have been growing faster than the other business units. Currently, the mix of OEM is approximately around 25 to 26%, and exports is around 20%, and replacement is around 54-55%. That's the way it has been. But the growth is more in OEMs. With respect to margins, you are right. Okay, it's more than 4 quarters since we reported double-digit margins. And in the last 4 quarters, we have seen unprecedented increase in raw material costs. We see that softening. Okay, our general approach would be to get it to double digits. We hope with softness in raw material prices and some price increase that we have taken in quarter 2, we hope to achieve it in due course of time. Okay. I'm not able to tell you the time frame, but we are seeing some correction in commodity prices.
Mr. Subbiah, sometime in FY23 you get to double digits? Quarter 4 you say is very seasonally strong, right? I mean, quarter 1 and quarter 4 are your best quarters. So maybe by quarter 4, given that operating leverage will play out, input costs will cool off, double digits possible by the end of this fiscal?
No, it is possible.
Okay, double-digit margins by the end of this fiscal. That's good to know. I guess the other reason why companies like yours could see better margins is because there's this wave of premiumization playing out, right? Tires with the more safety features, better technology, etc. And say Apollo Tyres, for example, launched their Vredestein tires last year, and that's 40% more expensive than Apollo Tyres itself. At your end, are you benefiting from premiumization? And if yes, how much would that help you with your margins?
Okay, from our side, there's a lot of focus on higher inch tires, which normally go into premium vehicles. Mm-hmm. And as a percentage of our total share, we are seeing improvement in, say, 14 or 15 inches plus kind of tires. Okay, but we don't have the kind of a product that you mentioned that one of the competitors has, where they price it at 30 or 40% premium. Okay, our range of products, various products with our own CEAT brand name, with different platforms, earn different margins. So we are seeing with higher sales of SUV vehicles and its impact on the replacement, we expect the overall margins as a mix to move up in the coming quarters.
Okay. Just, to talk a little bit about exports, we are seeing a lot of pressure in markets like Africa, Europe, and 20% of your own revenues comes from exports. Do you think that could put pressure on your overall business?
Yeah, it is. It is. In fact, last year there was a quantum jump in terms of our export share on the total value of the business. Exports grew very strongly last year, close to about 50% or so. But in the last 3-4 months, we are seeing some headwinds, specifically in Europe, and also in addition to Africa, some of our own neighboring countries also. So where due to currency availability issues, our own sales to Nepal, Sri Lanka, Bangladesh, we have seen some correction in addition to Europe and Africa. So we are seeing that in the current quarter also. We expect it to have some impact on our total growth in the current year, if it sustains.
All right, Mr. Subbiah, tell us what are the current capacity utilization levels that you're functioning at? That's point number one. Point number two is your capex. I think you lined up close to 1,000 crore capex. Could you confirm that? And what does it do to your debt levels, peak debt levels?
Okay, our capacity utilization, including bias categories of tires where there is a decline, say truck and bus bias, it's around 80 to 83% level. It varies from quarter to quarter. The newer ones, the radial side, the capacity utilization is more. The truck and bus bias, farm bias, utilization is a little less, and average works out around 82 to 83% of our available capacity. With respect to your second question on capex, the capex outlook that we gave in the beginning of the year for the current year is about 750 crores of project capex and about 150 to 200 crores of routine capex. Okay, and we keep reviewing this capex on quarter-on-quarter basis, depending on our operational cash flow and overall debt levels. So therefore, as we stand by that earlier estimate. With respect to debt, and in quarter one, we maintain our debt level more or less in line with where we were as of end of quarter four. So it's approximately about 2,100 crores. And we spent about 250 crores of capex in quarter one. So a lot of that capex that we incurred in quarter one was managed through our own internal accruals and efficiencies in working capital. So internally, we have a threshold of keeping our capex at, say, less than debt equity of 1 and debt EBITDA of around 3. So we continue to follow the discipline going forward. We would continue to follow.
Okay, but on the debt, this almost 2,100 crores is something that you ended FY22 with as well. And now with your capex, perhaps, the fear is that there could be more debt, incremental debt taking on board. Any plans to reduce it at all?
See, in quarter one, what happened, we incurred 250 crores and we still maintained at 2,100 crores. That was a number that we ended up as of 31st March too. So therefore, it's more about how much capex that we incur in balance part of the year. We expect our debt level to move up. We have not cut down any of our project capex as of now. So except truck and bus radial tires that we have pushed it by a couple of quarters, that was announced earlier. So we expect debt level to move up during the course of the year in line with our incremental project capex. Okay, however, it will be managed well within that overall debt EBITDA number of around 3 is what we are aiming at. So if you can afford and if you can generate more operational cash flow, we will incur that capex. In the event we see some downsides, we would cut our capex. That is the approach. So we don't expect our capex debt to come down in the current year. It could marginally go up in the coming quarters.
Okay, so just one last number on the top line. What are you looking at by the end of the year? 10%, 12%? Can you even do 15%?
Okay, see, quarter one, we grew by 50% over the same quarter of last year. But however, I just want to highlight last year, quarter one, we were impacted by wave 2 of COVID. So therefore, it's not a clear comparison. I think we expect a strong double-digit growth in the current year, assuming that there is no impact on account of pandemic in the current year. So as we said, a volume plus value growth would be high double-digit number, anywhere between around 15% types is what we are looking at this point in time.